Investing can be a great way to grow your money over time, but it can also be tricky, especially for beginners. Imagine Sarah, a 25-year-old professional who decided to start investing her savings. Excited about the potential to earn more, she jumped in without much planning. A year later, Sarah found herself with $10,000 less than she started with. What went wrong? Many new investors, like Sarah, make mistakes that can cost them a lot. These mistakes are often avoidable with the right knowledge and planning. This video will explore the top 7 mistakes that beginners often make when they start investing. By understanding these pitfalls, you can avoid them and make smarter investment choices. Investing doesn't have to be scary or complicated. With a little guidance, you can navigate the investment world with confidence. Whether you're just starting or have already begun your investing journey, learning about these common mistakes can help you build a stronger financial future. So, let's dive in and discover what not to do when you start investing. Mistake 1. Not having a clear investment plan. Starting to invest without a clear plan is like setting off on a road trip without a map. Not having a plan can lead to impulsive decisions and emotional reactions to market changes. It's easy to get swayed by the latest news or a friend's advice, but this often results in buying high and selling low. Without a roadmap, you won't know where you're headed or how to measure your progress. Creating a clear investment plan involves setting specific financial goals. Do you want to save for a house, your child's education, or retirement? Next, determine your risk tolerance. Are you comfortable with high-risk investments, or do you prefer safer options? Finally, choose a diversified portfolio that matches your goals and risk level. By having a well-thought-out plan, you can stay focused and make informed decisions. Mistake 2. Ignoring diversification. Imagine putting all your money into one stock, thinking it will make you rich. Ignoring diversification is a common mistake among new investors. When you put all your money into one investment, you're taking a big risk. If that investment fails, you could lose a lot, if not all, of your money. Diversification means spreading your money across different types of investments, such as stocks, bonds, and real estate. This way, if one investment doesn't perform well, the others can help balance out the loss. Think of diversification like a balanced diet. Just as your body needs a variety of nutrients to stay healthy, your investment portfolio needs a mix of assets to grow steadily. By investing in different industries and asset classes, you reduce your risk and increase your chances of steady returns. To diversify effectively, also, invest in different sectors like technology, healthcare, and consumer goods. Mistake 3. Trying to time the market. Trying to time the market means guessing when prices will rise or fall to buy low and sell high. It sounds smart, but even experienced investors struggle with it. Timing the market is like trying to predict the weather. Sometimes you might get it right, but often you'll get it wrong. The stock market is unpredictable, and prices can change quickly for many reasons. Even experts can't consistently predict these changes. Instead of trying to time the market, focus on a long-term investment strategy. This means buying quality investments and holding them for several years. Over time, the market tends to go up, even though there are ups and downs along the way. By staying invested, you can ride out the bad times and benefit from the good times. One helpful strategy is dollar cost averaging. This means investing a fixed amount of money regularly, no matter what the market is doing. This way, you buy more shares when prices are low and fewer shares when prices are high, averaging out the cost over time. Mistake 4. Overreacting to market volatility. Market volatility means the prices of stocks and other investments go up and down a lot. It's normal for the market to have these fluctuations, but many new investors panic when they see big drops. Overreacting to market volatility can lead to bad decisions. When you panic and sell during a downturn, you lock in your losses and miss the chance for your investments to recover. It's important to remember that the market has always rebounded from past downturns, even though it can take time. Instead of reacting to short-term market changes, focus on your long-term goals. Understand that volatility is a part of investing, and it's normal for prices to fluctuate. If you have a well-diversified portfolio and a solid investment plan, you're more likely to weather the ups and downs. Stay calm and avoid making impulsive decisions based on fear. Stick to your investment plan and remember why you invested in the first place. Keep in mind that investing is a long-term journey and patience is key. Mistake 5. Failing to do proper research. Jumping into investments without proper research is like diving into a pool without knowing how deep it is. Failing to do proper research can lead to poor investment choices. Investing based on tips, trends, or gut feelings is risky. Each investment has its own set of risks and potential rewards, and understanding these is crucial for making informed decisions. Before investing, take the time to learn about the company or asset. Look at financial statements to understand its performance, profitability, and growth potential. Read news articles, reports, and expert analyses to get a comprehensive view of the market and industry. Also, consider the company's competitors and overall market conditions. Doing your homework helps you make better choices and avoid investments that don't align with your goals or risk tolerance. By being informed, you can make decisions based on facts, not just opinions or trends. Proper research gives you confidence in your investments and increases your chances of success in the long run. Mistake 6. Not understanding fees and expenses. Many new investors overlook the impact of fees and expenses on their investments. Fees and expenses might seem small, but they can add up and significantly affect your investment growth. Common fees include management fees for mutual funds, transaction fees for buying and selling stocks, and expense ratios for ETFs. These costs can reduce your overall returns, especially over long periods. To avoid this mistake, it's important to understand all the fees associated with your investments. Before you invest, check the expense ratios of mutual funds and ETFs. Look for low-cost options, such as index funds, which typically have lower fees. Be aware of any transaction fees your broker charges and try to minimize trading to reduce these costs. Additionally, consider the impact of these fees on your long-term goals. Even a small difference in fees can lead to thousands of dollars lost over time. Mistake 7. Ignoring tax implications. Ignoring tax implications can be a costly mistake for new investors. Taxes can take a big bite out of your investment returns if you're not careful. Different types of investments and accounts are taxed differently. For example, stocks held for less than a year are taxed at a higher rate than those held for longer. Additionally, dividends and interest income are also subject to taxes. To avoid this mistake, it's important to understand how taxes affect your investments. Consider using tax-advantaged accounts like IRAs or 401(k)s, which offer tax benefits that can help your money grow faster. Be mindful of capital gains taxes and try to hold investments for more than a year to qualify for lower long-term capital gains rates. Another strategy is tax loss harvesting, where you sell losing investments to offset gains from winning investments, reducing your overall tax bill. Remember, every great investor started as a beginner. Learning from mistakes and gaining knowledge over time will help you become a more confident and successful investor. Now, if you want to learn how to achieve financial success, then watch this video next. And if you made it to this point of the video, please like and subscribe to the channel to see more content like this. Thanks for watching, and I'll see you in the next video.